This is hour number 2, and we have a really great hour to complement number 1. Wouldn't you say, gentlemen?
Yeah, well, we get to talk about condos, which is exciting.
I like to give compliments, so that's exciting.
Yeah. This hour we have Miss Deborah Barnes. She's a CPA with, is it Baird Financial?
Yeah. Baird Financial Services. Yeah.
Financial Services and Private Wealth Management. And we got a lot to cover with her. And before we do, Adam, let's dive into your tip because we can get so wrapped in with our guests.
Yeah, we can. Well, we might need more than 2 minutes, but do you want to lead us off?
Okay, so
3.5 minute tip of the week.
I ended up getting, and I always get the H03 and the H06 confused. I can never remember. I just think contents policy or not. But basically,
well, contents would be H04. So
yeah.
H03 is your.
Yeah, you got to break it down.
So you're talking about H03 versus H08.
So an H04.
Are you kidding me right now?
So an H03 is going to be. That's your standard homeowners policy, right? It's designed for single-family dwellings, okay? Or townhomes where the person is responsible for the outside maintenance of the home, right? Your H06, that's going to be your condo policy, right? So it's going to cover basically from the studs in.
Drywall in, right?
Drywall in, right?
Unless you have a renter, and then you need an H04.
The renter will need an H04. So an H04 is just a renter.
H04 is a renter policy.
That's just a renter's policy.
Yeah, so if you have a condo and you're a good landlord, you should have an H06 and force your tenant to have an H04.
We make the tenants
every landlord should make sure that their tenant has a renter's policy for sure. But what we were dealing with this week is it's a townhome, but it's written like a condo because the HOA covers the outside walls and roof, right? But it's on the beach, right? Or it's on the other side of the intercoastal. So it's in the wind zone, okay, which is going to make things difficult already. So
Indian Rocks Beach.
So
at least it's a block building, though.
Nope, it's frame.
Get out of here. So when I mentioned this, the homeowner was like, "No, it's block," and I meant to go back and look at it.
Well, the first floor might be block, but if you look all the way up, you can tell by the windows.
The upper part,
you can tell.
Right? So that's how I always look at it. So if the windows are flush against the wall, or close to flush, it's going to be frame. Right? If they're set back and there's that little ledge in between the outside wall and where the window starts, that's going to be masonry.
And if the window frame sticks out past the wall, it's stucco that's not thick enough.
You got a problem, right? So this house on the beach, it's in the wind zone. So in Florida, we have wind zones, right, where the state says if you're a standard homeowners carrier, you can exclude wind on the homeowners policy.
Now, wait a minute. Back up. Say that again.
Why would you ever want to exclude wind?
Well, you don't know. The carrier will say they'll write you an X-wind policy, so it covers all your normal perils except for wind.
Why?
Your agent should not be allowing that. I'm just saying.
Oh no, you don't have a choice sometimes. I'm talking about if this was a single-family dwelling, we probably would only maybe have one option that would do wind in the wind zone.
Are you serious?
Mm-hmm.
So let's break that down.
Okay.
Let's fast forward a little bit.
Let's break that down to the Aarons and Leos of the
That's
world.
exactly what I was thinking. Let's go into the Aaron and Leo realm where we've had a storm and you don't have a wind policy.
You missed a step. You missed what I said.
So we did.
So you have two policies, and in their case they probably have 3, right? You'll have a standard homeowners policy in HO3 that excludes wind.
Okay.
You'll have a wind only policy that covers for only the peril of wind. So, and it's going to match kind of what you have on your homeowner's policy.
Is that like a separate sinkhole policy or something?
Nope, it's just a separate policy. It's a real policy. Yeah,
this one is a real policy.
It's a real policy.
Sinkhole ones aren't real.
Yeah, and then you'll have a third policy in their case for flood, right? So that's kind of the difference there.
But do they need it if the master policy is covering that stuff?
So in the condo case, they're going to need it because they won't be able to get a loan without an HO6. Now,
so why do they need flood? Because there's nothing downstairs but a garage.
So if it's so for the condo, right? If the HOA, so let me break it down a little bit more.
Yeah, I'm missing some stuff.
Well, I'm talking about for single family.
This is Adam's first segment.
Okay.
The example we were talking about with 3 policies was for a single family dwelling.
Okay.
If you're getting into the condos.
I got it. Okay.
So if you're getting into the condos, The thing with flood on condos is the National Flood Insurance Program, right? The NFIP. That's what's backed by FEMA. All your insurance policies are 99% of them are that way, right?
So wait, I gotta ask a question.
You're not letting me finish, and it's going to answer your question, okay?
We think.
So possibly. So all the NFIP policies are exactly the same, right? It doesn't matter if it says Allstate or Progressive or Nationwide or whatever at the top. They're all the same. The FEMA says the NFIP says you can only insure one property for up to $250,000.
Okay.
Okay. So in your case with the condo, the HOA is covering the outside walls and roof. They should also have a flood policy.
Definitely.
If that flood policy already covers up to $250,000, they can't get coverage. They can get some excess coverage, but they can't get flood coverage.
Is that per unit?
That's per unit.
Okay.
But if it doesn't, what's going to be more likely is that the lender's going to say, okay, well, you need to get a flood policy that covers the gap between, let's say the HOA only covers it for $200,000. Cover the gap.
So you're talking about if it's like a $500,000 property or something.
Or
like
it can only go up to it just depends on what in that case for the flood, that's more lender based on what they're going to require. But that would be the only option we would have would be to cover the gap. But back to where we started on this, was the condo at the beach, right? So it's a townhome, frame construction, which is what's hurting us. It
actually shows in the legal description as a townhome.
It does, but the HOA covers it, right?
So we got an HO3 or HO6?
It's an HO6.
HO6 with an HO4?
No. Well, it doesn't matter. It doesn't matter. There's not a renter. You don't need an HO4.
HO6.
But the problem that we ran into there, and the reason the rate was so high was because it's in the wind zone. We're including wind. So it's not, instead of having two policies, he only has one, but it's frame construction. So everything, and what we're seeing with condo policies is the rates are going up.
Yeah.
Going way, way up. Because you have situations like what happened to Leo yesterday, right? There's damage from something happened in a different unit, not even his, but now he has damage.
Actually, what ended up happening was the sprinkler pipe, it got cold enough in the attic to freeze the pipe, and the pipe busted because the water, when it freezes, actually expands.
Was that here locally?
Yeah, it was here locally.
Ybor.
Wow.
Yeah.
Well, you can have like bridges. You ever notice when you're driving around in your car and the little... It happens very infrequently, but the little freeze warning comes on, but it's above 32 degrees. The reason why that happens is when you're on a bridge, bridges can freeze over at around 38 degrees. And the reason why they do that is because you get that airflow on both sides, and it actually is colder than the ambient outside air. So in your attic, those sprinkler pipes are the same way. They can freeze at 38 degrees, and we had 37 degrees. So that pipe froze.
Yeah.
It snapped, and 15 units got flooded, and I was on the top floor. Now, you're thinking that that's the worst place to be in a situation like this. No, the bottom floor.
Because that's where it's draining. Water goes down, right?
So
heat goes up and water goes down.
So anytime I'm looking to buy a condo ever, I never buy on the first floor.
That is good advice.
Because when you get your water loss, that is going to be the worst. It's going to take 3 to 4 days. Even if they're drying out the units above it, it's going to take 3 to 4 days for that water to get down.
I'll tell you one more thing, too. And this is going back so far. Like, I wasn't married. I was by myself. And I lived in an apartment. I did not pick a bottom floor. I picked an upstairs floor because I figured it'd be less likely for burglars to break in.
Yeah.
I was by myself.
That's probably true.
That's true.
But so anyways, back to the condos. We're seeing condo rates go up just like everything else, right? Properties going up across. So
but you didn't answer my question.
What was the question, though?
You got me lower workers' comp.
That is true.
I was shocked.
The state got you lower workers' comp.
I was shocked. I'm like, all my other insurance is going up 20, 30%. He's like, your workers' comp went down 15%. I'm like, school.
Yeah, there we go. So anyways, your question.
So my question is, when you're looking at a regular homeowner's policy, HO3, and you've got the hurricane deductible and all that stuff you're looking at on the policy, that wind is not included in that?
It should be, unless you're in the wind zone. So like that's what I'm saying. There's like a sliver,
a wind exclusion loan
on the west side of Florida. It's typically anything that's west of the intercoastal.
Okay.
Are you talking about the mile west of the water or the 800 feet west of the water?
I'm just saying, like, as far as what can be where they can exclude wind, and you have to get a separate policy. On the west side, it's typically west of the intercoastal. On the east coast of Florida, it's east of I-95, generally speaking.
And the prices for those are significant, I would imagine?
It depends.
Age of home,
just like anything else, age of home, construction, roof type, roof shape, wind mitt credits. Do you have the windows? At that point, when you're in the wind zone, it definitely matters to have all your windows and your opening protection
how do you
credits, all that
know?
stuff.
If you're looking at your policy, how do you know that it does not include wind?
You text your address and name over to 813-377-2775. That's 813-377-2775.
And Adam can look at it.
Adam will look at it for you.
How do I know?
I couldn't. Well, if you have a hurricane deductible, you know you have wind.
Okay, good.
You know, generally speaking, you'll know that you don't have wind because I would.
Don't have to disclose.
Yeah, who would ever sell a policy without wind and not tell the person? That's a great way to get sued.
But you have to do a disclosure, right? I would imagine, yeah? Or you should.
They sign the application, but that's about it.
You're not mandated enough. It's Tampa Home Talk. We'll be back in a minute. Stick around.
Good morning. Welcome back. We're still on Adam's 2-minute tip of the week.
No, we're done with that. We're moving on.
We were talking about maintenance.
We're going to save that for another. We're going to do a whole show on what is your HO whatever for insurance.
There you go.
That's what we're going to do.
Yeah. Oh, the number game. I love numbers.
Yeah. Call it bingo.
Does it say it on the policy, the HO whatever?
It should. Yeah, it should say HO3, HO4.
Never paid attention to that.
You'll know by what coverages you have.
Or what coverages you don't.
All right. So we're going to dive into Miss Deborah Barnes. She's a fan of the show. She's actually listened to us in Tampa Home Talk before, and she got a call to be our guest, and she's like, yippee, I'm going to go.
I love meeting fans.
So we're going to talk a little bit about, she wants to know, we're going to talk about what happened with the markets and the economy, right? With this whole COVID shutdown and this nonsense and how this is going to affect stuff. And it's so up and down, it can drive you nuts, for me anyway, just watching it all the time. So let's chat about that. What just happened with this whole, like in the middle of a presidential election too, right?
Exactly. So you said it. It was a shutdown of the economy. We didn't have a systematic problem like we had in 2008 with the real estate market, which we all lived through. We had a shutdown due to COVID. And what that did, it created extreme volatility. People, it was drastic. On February 19th, we had an all-time high. Come March 19th for 16 days.
Yeah, that was pretty crazy.
We had a steep decline of 34%.
I couldn't get my financial account set up fast enough to do stocks.
Right. And then, March 23rd is the low, and then the 3 days following, we had a 20% jump.
I know, that's like crazy volatility, isn't it? Like, it's not even cryptocurrency, it's the regular market.
Right, exactly, and it was just unprecedented. And so the first quarter was our 9th worst market in history. And then our second quarter was the 9th best market in market history.
This just goes to show you I don't watch stuff like that. Maybe you do, Leo, or you guys notice. We keep our tabs on like the real estate market, but I didn't realize that we just came out of like the worst quarter and then followed by the best quarter.
Yeah, the 9th worst and the 9th. So like it was so quick, and so part of it was we had quick reaction by the Federal Reserve. They changed interest rates. They pumped money into the economy to keep things going. Not just in the United States, but internationally, because we're the currency. Congress and the president reacted with relief for businesses and consumers. So,
do you think that will change in the future with the U.S. being the world currency?
Let's hope not.
I hope not too, but it's just a curious question.
Yeah, I don't see that happening anytime soon. Some drastic things would have to happen in the world, but never say never, but I'm not expecting that.
So what do you think about like this market? And that might be kind of a loaded question, right? Like, where do you think we're going, just changing presidents after all this craziness in the market for a year?
Well, I think that the projection is that, profits drive markets, not politics, and not,
That's true.
And so we've had slowdowns, and that kind of brings me to my next point, the difference between the stock market and the broader economy. That was a common question. People were like, how can the market be doing so good? And, we have businesses shut down. But let's step back. The stock market reflects large companies. So their price is set based on the present value of future cash flows for numbers of years projected of what kind of profit and money they're going to make. So if you take that in consideration, a year or two shutdown or slowdown isn't such a big deal.
Right.
But for the people who are out there running their business and it's a current situation and they can't open because our small businesses were so impacted and regulated and couldn't open, so they were impacted more.
Question for you: do you think all the economic strains or conditions are localized? Like, do you see it differently in different?
I feel like
like if you're in Orlando, you probably have a lot of if you have vacation rentals, those aren't getting sold. Disney's down, people are losing jobs. It's all heavily driven by tourism. Where around here, it's less so, right? And that's why you only have 800 houses on the market right now.
For a week.
And I think it's driven by how the local officials are mandating things. I think it's different based on down in Miami and places like that. They had much more dense populations, so they had stricter rules and people were more afraid to go out. And then our governor allowed for it to be more localized, where in some states it's still shut down. And so it is. I think
can't even imagine that.
I couldn't live in California. I couldn't do it.
So it's so it is regional, state, and even down to local, depending on what your state is allowing.
So what about companies like the airlines, right? You were talking about how their stock price predicts their future valuation and that sort of stuff. The airlines are having a hard time, and they got some bailout money. And I don't know how business travel will resume.
Right. So there are areas of the market that are impacted this time versus last time, and there's some that are doing great. Like the tech is doing great, but remember in the 90s we had the tech bubble and they didn't do so great. So
some of them did.
That's the that's where you prepare, and that's where these things happen about depending on how you calculate it.
We're overdue, right, for that market correction?
Right. So we just had the longest running bull market, which was 11 years. On average, once you put that one in the mix, it becomes every 9 years. Before we had this longer one, it was a little bit shorter. But the point is, these things happen. They happen periodically. They last year and a half, 2 years. It just depends. So you want to plan for it, and you want to have the right cash flow, and you want to have the right safety net in place. So when it does happen, you're prepared.
What's the best way for somebody to prepare for that now, right? You're saying it's been an 11-year bull market. It's been really strong. So we're expecting that cyclical stock market dip. What's the best way to prepare for that?
So it's
probably a loaded question, right? Depending on where you are, like if you're going into retirement, if you're looking to invest.
Exactly. So having a safety net is the right way to do it for everyone. But how much you have is different. And having financial plans in place is something that everyone should be doing. And like you were saying, based on your stage of life, your net worth, your comfort level, these are all things to take into consideration, and also if you're getting closer to retirement versus young, and if you're in the distribution phase.
So let's talk about those couple ends of the spectrum, right? So let's talk about the younger generation maybe that has not put very little or hardly any money into the stock market, and they're listening to this program and they said, wow, it's 11-year bull market. It's been super strong. I'm going to wait for a dip. What are your recommendations for that person listening?
So timing the market, as we just saw, is hard. So trying to wait for a dip, you're missing the growth. So it's not necessarily trying to time to buy the bottom. It's more putting a plan in place and systematically implementing it and make it more automatic. Like if you have a retirement plan with your employer, you need to be making sure that you're putting away. And historically, it's been encouraged to put in enough to take advantage of what your employer gives you is a benefit.
Definitely.
And that's just not enough. We're in a really low return environment.
Right now, because rates are low.
And it's been this way for a while. So in like the 80s and 90s, you can make 6-8% on
Well,
your cash. Now you
yeah.
can make nothing.
But in the 80s and 90s, the interest rates for buying a home were also like 18-19%.
Exactly,
So-
and crazy high. So, but that doesn't change. You need to save for retirement. So, in those years, getting $1 million, you could live on $1 million in cash.
Now it's
and
not
now
as far as,
you need so much more. So that 3 to 5% that they would tell you before to save for retirement is just not enough. It really needs to be closer to 15% for younger people, putting it away systematically.
So being that cash is not, you're not getting that return, obviously diversify, but what's your thoughts on that? Like if you're not, I mean, if interest rates are so low, it would make sense to me that you should put that money into an investment property, especially when we're saying things like the average home price is going to be $509,000.
That's the best
you
bank
know,
account
by
there
9
is.
years from now.
Yeah,
What?
making sure
A
you
home.
For savings.
Yeah, home ownership is and people's net worth is important, and having a home is part of it, but it's not your retirement plan because it's not going to fund. You're still going to need a roof on your head when you go to retire. So it is, your home isn't your retirement plan. You need to have those investments to generate the income that you need.
I'm talking about investment properties though.
Yeah,
Like
well,
that
that is a good diversification, but in the market, you also want to be diverse in the number of shares that you have of different types of market sector. Like you said, the airline industry is suffering this time. It also suffered during 9/11.
Yeah.
Then you had the tech that suffered in 90s, and so now it's doing great. It's driving our market. So you want to have a diversified portfolio in all kinds of sectors, and real estate is a good investment, but it's also had its ups and downs.
Definitely.
And every tenant
Hold that
isn't
thought.
good.
We're going to talk about that a little bit more when we come back after the break, as well as the other end of the spectrum. Back in a moment.
Well, good morning. Welcome back. Our studio just doubled in size. Our studio audience.
Yeah,
studio
not the
participation.
Studio Vision, or Studio, oh gosh, Vision.
Vision
Visitors.
State Vision Board.
Visitors.
You got 2021 on the mind. You're doing your vision boards and goal planning.
Yeah, I need to finish my business planning. It's rolling into next week. I'm a little late to the party there.
Well, we
on that
have a
one.
financial planner here to help with your business planning.
We do. So we were talking before the last break about how do you prepare for this bull market? How can you invest money to move forward? So you're saying strategically save about 15%, have a plan, put that in the market, you should be okay in retirement.
You want to pay attention to how much risk you take. So for young people, they can take more risk. It's a longer period of time. But
Right.
when you start to get to that stage where you're getting closer to retirement and the withdrawal and distribution phase, you want to tone that risk down.
Okay.
So, and when I say risk, equities 100% in stocks versus bonds, that's the top of the risk. 100% bonds is on the lower side of the risk. It's just above cash. And so for people who are approaching retirement, you want to start turning that risk down because you're going to have more volatility like we just saw. And so if you need to distribute during that time, you don't want to have to distribute on the low end. And that's where that safety net comes in that you have. So for people who are approaching retirement, you tone the risk down.
So let's say someone that is, let's go with 55. They're 55. Do you think that they're at the age where they should tone it down or not yet? They're planning to work 10 more years.
So compared to somebody who's 25 or 35, yes. So moving from, 100% equities to 80% to close to retirement at 60%, because and it also takes into consideration people's comfort level.
Mm-hmm.
So one client will be, I don't mind the
with it.
risk. I'm not going to look at it. Just put it in. And others are looking at it daily, weekly, monthly, and getting nervous. So your plans are unique to the person that you're dealing with, and every person is different. So we tailor plans to the person's needs.
So a question for you there. You're saying as you get older, go into something more conservative like bonds, but are bonds even, like, what's their return right now?
So it depends if it's corporate, municipal, or the difference. So it
What's the
ranges.
range? Yeah.
So 2% to 4 or 5%, and it depends on the risk level of, there's A rated, B rated, so the lower the rating is, the more payout that you get. So you do, let's face it, most people invest through mutual funds or ETFs versus straight into a bond position or straight into a stock position. It's a easier way for people to get in, and they're assured there's some management
it's a variation
going on.
Of stocks.
But there's, yes, exactly, and you can create some diversification that way. And most people's retirement plans are in it. A lot of people are doing target age retirement where they're getting that built in lowering the risk as you get closer to retirement. So
one of the questions we have from our listeners is, how do they set limits on the 401k investments? And he's asking 50% and saying he has corporate funds.
Okay.
See, basically, I think we were talking about comfort level, right, with stocks and bonds and where you're moving stuff based on your age. And so he was asking if you should set limits on the 401k investment.
Well,
and that might be pertaining to the market being a bull market. I'm not sure when that comment came in.
Yeah, I'm not exactly sure what the...
So why don't you do this, Michael? Let's re-ask that question, and then I'll ask Deborah that so we can be really clear on the question first.
Great.
Sound good?
Yes.
All right.
Sounds perfect.
So what about for the other end of the spectrum, which we said we're going to talk about? So you're already in retirement or you just retired, right?
Okay.
We're in a bull market right now. What should you be doing?
Well, you want to have a financial plan, and you want to have your goals, and you want to create your plans to focus on the goals. So if you're in retirement, you want to make sure you're not taking too much out each year and too much out earlier. People's life expectancy is 90.
Extended, yeah.
90 something. So you could be in retirement 25 to 30 years. So you want to make sure you're taking out the right amount. So assuming you're investing and you're getting a 6% return, you only want to take out 4%. So the suggested withdrawal rate is 4%. This will help to ensure that it's sustainable throughout life. If you do too much too soon, you are going to potentially run out kind of quickly.
Here's the big thing. When I had Chris Hogan on and we were talking to him, he wrote the book Everyday Millionaires. Yep. And, his big thing is retirement's not an age, it's a financial number. And that makes sense.
Yeah.
And so my thinking going into that is, and certainly you can chime in after this, but don't have a housing payment going into retirement. That should be number one. There should be no housing payment. And then, so how do you plan or adjust retirement based on that?
I agree with you. Home ownership and having your home paid off and not having to come up with rent during retirement is a great plan.
Yeah.
And it helps to ensure that the budget that you've created for yourself during retirement is going to living.
But by the way, you're never too old, so I expect house prices, rent prices, mortgage payments, everything to rise.
Yes.
There was just an article in the Tampa Board of Realtors that an agent just helped someone 73 years old buy their first house. And by the way, this question I've gotten a lot from people around, and I've had a lot of people in their 60s actually buy their first house. And what I tell people is, and they'll ask this all the time, can I get a 30-year mortgage? And the answer is absolutely. The bank is discriminating if they don't give you a 30-year mortgage. So, yeah, because they're concerned they might have to take, I guess, a 10 or a 15-year.
Yeah, and create a bigger payment for themselves.
So even if you're in your 60s or 70s, highly encourage you to own a property. Number one, you can control your housing cost.
Yes.
You can't control your rent payment, so they can increase it, whenever they want. And number two is you can't control the market. So if the median home price is indeed $509,000 by 2030, it'd be really nice to have a set housing payment.
Definitely. And so the safety net question and in retirement question of so when markets go down, they go down and stay down for about a year and a half. So my clients who are nervous or don't have a pension or a fixed income payment, we put a year and a half to 2 years of cash on the side for them, so we don't have to sell in a down market. And so their goal and plans and investments during a bull market can also stay in there. And so everything's plan based, so we don't get too much change.
And have some reserves. I mean, I'm a big fan of saving 15 to 20% of your income only for wealth building. You don't spend that on anything. You can't buy a boat with it. You can't buy a car with it. It's only for wealth building. So if you get an opportunity.
Mental wealth.
No,
I need the car and the boat and the TV.
No. If it has wheels or a motor, it goes down in value, right? So it's a good rule of thumb that Dave Ramsey uses. But
brains are like motors.
Yeah, they're not. Yeah. So basically, that's my thought is put it in something that will make money. So whether it's a down payment on an investment property, it is a stock that you feel good about, it is an ETF, exchange traded funds. Where else could they put that? They're saving 15, 20% of money. What other investment avenues besides the market and real estate?
There are alternatives out there, and people do work in the annuity space. That's a place that I am able to work with clients that can help people get some kind of, there's fixed and variable types of annuities to create that cash flow for you that's creating your own type of pension. So that's another avenue that people go. Then there's real estate investment trust. If you want to be in real estate, but you don't want to have to do the management yourself, you can go through
a REIT.
Yeah. So
also known as a REIT.
Yes. Exactly. So there are.
So why don't you explain how the REITs work, the real estate investment trust?
So there's a lot of difference in them. Some of them are partnership type where you get a K1 and you have to wait for the K1 when you do your taxes, and some of them are mutual fund type investments where you can buy in and out. So there's a lot of difference in it, but basically what it is, the real estate investment is the focus of this investment, and that's what's driving the returns and what you own inside of it.
And there's always other avenues too. Like I think so many people have their mind closed to that's the only two ways to multiply money, but really it's not. I mean, when you look around, there's just a ton of other opportunities. Everything from private lending, like private lending your own money.
Yeah.
To me personally, I'm a big fan of holding private mortgages. Mm-hmm. But again, like Dave says, invest in what you know. Mm-hmm. And so for me, I know that I would rather put money into holding a mortgage, right, being a bank or buying real estate than I would the market because I understand it better and I have control over it.
Right. And so that can also create some concentration risk. So if you're too tied to one market or one segment, just like business owners that they think their business is their retirement plan. It's just another one of your assets.
Right.
And you need to plan accordingly and have an exit strategy for that. So you can get too concentrated in one place. So you want to make sure you have some diversification.
Are always going to need a place to live. That's the thing.
Yes, but you're still going to have to pay your utilities and your cable. And so you're going to have to create that income stream for yourself to be able to pay those because you're still going to need a roof over your head.
Got it. All right, so what about, let's ask one more question. I think we may be taking a call. So what about gold or silver? How do you feel about that right now, and where is that price right now compared to historically speaking?
Gold is higher than it was before this. And
before COVID started?
Yes. And it also is going up and down. Like all of these markets go up and down, commodities. And commodities is something that you can invest in to create some diversification for yourself. And but being in one space is just too much. So like 70% of losses happen during these downturns. And
then they bounce back.
Yeah, exactly. So you don't want to, no, if you sell out,
not if you sell. No, I'm talking about holding.
It'll come. Yeah. So the point is not to sell, not to overreact. And according to Fidelity, 40% of the do-it-yourselfers who are investing for themselves that are 65 years old, 40% of them went all to cash. So that's like putting emotion in it. You've got a permanent loss now.
All right.
And so you don't want to get too emotional. You want to stick with your financial plan and your goals and not get too reactionary. And
so real quick, we want to take a call real quick from a caller, and then we're going to answer it when we come back after the break and then roll to Kevin. So we're going to quickly run out of time. But Michael, welcome to Tampa Home Talk. What's your question? Is he there?
I got a question. In my 401ks, at least what I've got currently, I I think I can set sell limits or whatever the case might be. So if the market does crash, what should I sell over to? And I know that's not your specialty or whatever the case might be, but I do have a real estate investment option in there, and it's not doing well, by the way, from Fidelity mainly. It's the one thing that is actually down, which is very interesting. It's like a...
Hang on, Michael. We'll be right back. Stick around. Welcome back. This is Tampa Home Talk. And so just to recap Michael's question here, he's got some money in the market. He's got a lot with his current employer. He's also got some in real estate that is not doing well. And then my question, what we were talking about during the break, is how is that invested? Is it commercial real estate? Where is it? Because if it's not doing well, that's probably where it's at. Like if it's all in Orlando right now on timeshares, you're probably not doing so fabulous. So his question is, if the market tanks, what should he do? Should he sell into bonds? Should he go to buy gold or silver? And can he put stop losses on if that stock price goes down a certain amount, including his employer he's with? Can he sell it and transfer it into something else?
Right. And I was saying 401ks are different. Not everybody has these options. And you want to just pay attention first. What is your asset allocation and what is appropriate for you? So deciding where to go and what to get into, you want to still take into consideration the level of risk that you have and what your allocation is and what you want it to be. So then you also want to be diversified in that and be in all kinds of market sectors. So right now your real estate investment is not doing great. We don't know the details if it's commercial or if it's residential or how it is invested.
I think his question was more on like the stop losses for the sell on the stock.
Right. So where to go? So if you're a person who has a 60-40, only 60% stocks and 40% bonds, and you're selling a stock, you're going to want to put it in something that is going to create that return for you.
So let's say it's 60% stock. He's got a lot of that with his employer. He wants to know at what point should he sell? What point of a loss? 50%? Like where should he put a stop loss sell in?
It's also based on your comfort, and if you sell, you're creating that loss for yourself, and that's assuming a loss. Right. He might not actually have a loss. He just might have a point where he wants to sell some and get out of it and move into something. Exactly, and change that allocation and maybe rebalance things or add another sector. And the commodities market is a good thing, but not putting all your eggs in one basket. So that 5 to 10% of your portfolio, moving it into some kind of commodity, whether it's gold or silver, so is an idea.
What would you do right now? What do you think is more? I personally would say gold or silver. I'm not the financial advisor. I'm the real estate expert, but I personally would move into gold or silver. What do you think?
Keeping the asset allocation and sectors in mind and diversification in mind, 5 or 10%. You don't want so many people react, like I was saying with Fidelity, and do a lot and do big chunks. You don't want.
Here's the thing,
you want to keep your overall.
You look at like
mind.
Venezuela, and you think, okay, anything could happen. And if you had invested in gold, you can move that to anywhere in the world, assuming there's a new superpower. It's just that's the only reason why I say that. So, all right, we do need to change gears and go to Kevin Littardello at AIU Underwriters and Payroll. So. Welcome back.
Thanks for having me.
We haven't had you in a while. You're a little bit intrigued by the conversation here, right?
I am. I like what my 401k is doing, but listen to your conversation. I think it depends on how old you are, too. If you want to, it's a buyer's market, I mean, if it goes down, but, you know, it's hard to answer. You know.
That's why it
depends on how long you plan to work, too, right?
Exactly, exactly.
So you are doing AIU payroll and all kinds of stuff.
Yeah. Well, it's all insurance underwriters, and
which by the way, you were talking about how your workers' compensation went down.
Yeah.
Adam can actually write it through them, FYI.
Oh, he could?
Yeah.
Oh, well.
Do business with both of them.
Yeah, I think. Are we going to lunch with Adam today? No. Okay. Sorry, my bad.
Different day.
Okay. That's something we'd like to talk about, though. So, All Insurance Underwriters is the mother company with all AIU payroll underneath it, and also all industry underwriters. And so that between those three companies, we can handle anything having to do with commercial insurance and provide an economic solution that makes sense. So Now, last time I was on the show, we were talking about employee leasing or professional employment organization.
Right.
But today, I wanted to talk about what we do in the standard line insurance market, and that's providing. Now, I'm a wholesaler, so it's a managing general agency. So we provide commercial insurance to retail agents nationwide, and the benefit there is we have about 50 employees with the underwriting department. A policy department, a renewal department. So we want to be an extension of the retail agent. We want to act as their office outside their office so they can spend time in the field building relationships. And
that's what my whole book's about. Have you read it yet?
No, I have not.
Not yet.
No,
Nobody's read it.
I've given it to
me a year to write it.
Let me read it.
I know I'm going to. I got to get my questions ready
You
for
won't
you.
let me read it.
I will. Are you here next week?
Yes. Okay. No, I'm getting my mold assessor test.
Okay, the week after, maybe? I don't
Yes.
know. Okay. We'll do it then. Go ahead.
So one of the caveats we have at all insurance underwriters is we have great relationships with our carriers. And, with that being said, we have a lot of high volume with them. We really look at our submissions to make sure they're accurate and clean. So when we send them to our carriers, it kind of goes to the top. Like anything, if you're used to getting a submission that you have to go back and fill in the blanks and all that, you kind of tend to put it to the side and, and go for the ones that you can make a decision quickly. And we kind of built that reputation with our carriers, and it trickles down to our retail agents nationwide. So we supply a decent turnaround time. We try to hit the targets that they're looking for so they can present it to their consumers, their prospects, hopefully will be clients. And that's kind of our model.
So if you're an insurance agency listening, you guys are a great connection for them.
I would definitely say so. We're high touch. We are awarded with our carriers with great retention rates. The renewal has everything to do with about building profits in your agency. It's not about always just signing new accounts. It's keeping the ones you have, and we realize how important that is, and we supply a lot of energy in those departments. So and then we have programs. We have unique programs that are hard to find. If you want me to would you like me to give you some examples of what we do that is unique? Well, we have a home health care program, and that has to do with assisted living, professional and non. Even during COVID, we kept writing that because we have a captive in there. So with that being said, we share risk, and we have more direction with that.
Shared risk usually means better premiums.
It does, and it's like we have a say. We negotiate for our retail agents nationwide. So if there's a story behind it, a reason why we need to write it, I want to hear it, and we want to go to bat for them.
This is like how it used to be in the mortgage world. Like you could actually talk to an underwriter and make sense of it and get it done. Those days are long gone in the mortgage world, by the way.
Yeah.
At least it exists in insurance, is what I'm hearing.
Well, one thing we do that I feel is long gone is we follow up. We answer the phone, we talk 7 o'clock at night. We do what is needed to get done to get that account bound.
I want to get you connected with Kevin if you have any questions, or also to Deborah, any of our experts. If you'd like to connect, just call or text. Let us know who you're looking for. 813-377-2775. 813-377-2775. You can call or text. Just let us know generally what you're looking for, and we'll follow up. We did get a question from our live stream. They want to know, how do we handle tenants who have not paid in 9 months? We can help you with that. Call or text 813-377-2775. We got the connection. We can tell you exactly how to handle it. There's different ways. Sometimes people actually muddy the waters when they don't need to. So if you have a tenant that hasn't paid, call us. 813-377-2775. Love where you live, and we'll fix it. Welcome home. See you next week.